ये जो फिक्स्ड इनकम वर्ड है ना, सो व्हाट डज इट मीन? इसका एक हिंदी ट्रांसलेशन अगर करोगे फिक्स्ड इनकम वर्ड का, you guys can keep guessing, and towards the end of the video I'll tell you what is the Hindi word for fixed income. All right, process of borrowing money from one entity to another and paying interest in exchange for that borrowing is fixed income investments. Promoter is setting up a company, they will bring in their own money, that is the promoter's money, and that money is called equity money. Equity money, you don't have to ever refund this money. Suppose somebody like you do this IPO these days, the company is raising money, the company doesn't ever have to repay that money back. All right, so that is equity. This is called own money. You own this money. You never have to repay. What is the Hindi word for fixed income? The Hindi word for fixed income is Hey Rinchi, good morning.
Good morning.
All right, so what's the topic for today, Rinchi?
I want to learn about fixed income.
Oh wow, fixed income.
Yes.
Interesting. So let me start with this. ये जो फिक्स्ड इनकम वर्ड है ना, सो व्हाट डज इट मीन? इसका एक हिंदी ट्रांसलेशन अगर करोगे फिक्स्ड इनकम वर्ड का, you guys can keep guessing, and towards the end of the video I'll tell you what is the Hindi word for fixed income. All right, so let me start this video on fixed income investments. Super. Let me write it. Fixed income. फिक्स्ड इनकम. एंड आप लोग सोचते रहो इसका हिंदी वर्ड क्या हो सकता है. सो व्हाट इज फिक्स्ड इनकम? फिक्स्ड इनकम इज एन इन्वेस्टमेंट वेयर somebody borrows from somebody else. So they borrow money. So A borrows money from B, and in return A pays interest. So they get money from B, and in return they pay interest. Okay, so the process of borrowing money from one entity to another and paying interest in exchange for that borrowing is fixed income investments. So every company, so suppose there is a company, okay, so there is a company, okay, let's say company X. This company will have a capital. What is capital? Capital is the initial pool of money that a company has for themselves, which they use to set up their business. Correct? A capital has got two variants. The first variant is equity. Equity. So suppose a promoter is setting up a company, they will bring in their own money. That is the promoter's money. And that money is called equity money. Equity money, you don't have to ever refund this money. Suppose somebody like you do this IPO these days, the company is raising money, the company doesn't ever have to repay that money back. All right, so that is equity. This is called own money. You own this money, you never have to repay. The other kind of money is debt. Debt money. This is called borrowed. Okay, borrowed money. If you borrow this money, like you borrow money, then you obviously have to repay that money. All right, clear? So equity, people give money under equity because they get dividend against that. Okay, people give money under borrowing debt because they get interest against that. So it's clear, right, why you give money under equity and why you give money under debt. All right, so when a company has to raise more capital and they are unable to raise more equity, every company would be loving to raise equity at some point, because equity you don't have to keep repaying. So there are certain positives of equity borrowing and then there are certain negatives of equity borrowing. Like, let me talk about one quick negative of equity borrowing so you will know that. So as a promoter, if I have to raise more equity, I have to keep diluting my stake. Because suppose I am hold 100% of the company and I need to raise additional equity. So I have to give away my stake, I have to give my shares to somebody else for them to subscribe to these shares, right? So I have to dilute my stake. So if I am not too worried about diluting my stake, I can keep raising more and more money through equity, and that is a very cheap form of raising capital. But the negative is that you have to keep diluting your stake. The other way to raise money is through fixed income or debt. You borrow money. If you borrow money, you're not diluting your stake because you have taken the money and you're again going to repay that money. The only thing that you have to keep in mind when you're borrowing money is that there is a maturity date. When you borrow money, suppose for example you take a home loan. Home loan will have defined interest payment dates and it will have a defined maturity date as well. So you have to be very sure that on those dates when you are supposed to pay your interest, you have money with you. So if you're not very sure that whether you will have money with you on those dates of repayment, then there is a risk. This risk of not able to pay money on time, this particular risk is called credit risk. Okay? Credit risk. So fixed income is a kind of investments which is dependent on this particular risk. So the return in the fixed income market is determined by this. Because we always keep saying, right, risk and return go hand in hand. So higher the credit risk, higher will be the interest that you will expect from that. Clear? Suppose there is a borrower who is at a very moderate level of risk. Okay, let me just put it up on the board so it is very clear. Suppose there is a borrower. This fellow has got a low risk, low credit risk. Okay, credit risk. And then there is another borrower who has got a high credit risk. My question to you is, which fellow will borrow at a higher rate? Will it be A or B? If the credit risk is low, this fellow will be able to borrow at a lower rate than B because this fellow, the risk is lower. As the risk keeps going higher, and suppose there is another C who has got a higher credit risk. So higher credit risk means this fellow has to pay a higher interest rate to borrow. So tomorrow, suppose I go to a home loan to take a, people will look at my CIBIL score, right? My CIBIL score is low, I have to pay a higher interest rate. If my CIBIL score is high, I have to pay a lower interest rate. Okay? So fixed income market is a market where there is a borrower and a lender, and it is an instrument. So this is an instrument. So when you borrow money, okay, suppose A is receiving money from B, A is receiving money from B, and A is paying interest. So when they borrow money, there is an exchange of an instrument. Like you have a loan document, it's called an instrument. Why is it called an instrument? Because instrument is able to be traded on the exchange. On the exchange. You can trade, like you can trade a security, like a share, equity share that you can trade in the stock exchange. Even an instrument, you can keep trading on the exchange. Hence, it is an investment. Okay? Hence, it is an investment or an asset. Suppose A has borrowed money from B, correct? So A will issue an instrument to B. So till the time A has borrowed money, so A will have money, B will have the instrument. Okay? Because he is the lender. All right. So B has taken an instrument from A, and against that instrument they have given him money. This instrument is called bond, or you can call it NCD, depending the kind of instrument it is. There can be other names to it. All right. So these bonds or NCDs are actually traded on the stock market. Okay. There is a listing happening and the exchange is happening and so on and so forth. Clear?
Yes.
Super. I think for fixed income, we will stop here today. It's a very deep subject. We will keep discussing about fixed income more and more as we go ahead. So one thing, what did you learn? Fixed income is all about being confident that the money that you have lent to somebody else always comes back to you on time. So this is important. Nobody would like to lend money to somebody where the money doesn't come back to you on time. So you have to be very sure that the income that you receive is always fixed. There is no change in that income. Suppose, for example, let me give you an example. A and B. Suppose they have given money for 5 years, okay, at the rate of, let's say, 10%. Okay. So that means every year, and they have given, let's say, 100 rupees. So A will receive 10 rupees in first year, 10 rupees in second year, 10 rupees in third year, 10 rupees in the fourth year, 10 rupees in the fifth year, plus that 100 rupees will come back. Correct? You have borrowed money for 100 rupees. So you'll keep paying 10 rupees, 10 rupees, 10 rupees, and will come back 100 rupees. So this is what it is. So you have to be very certain that this money is always coming back to me. Okay, and it is fixed. So the income is fixed. Income is fixed. Income is fixed. Income is fixed. So I give 100 rupees today and I get back 100 rupees. So the maturity money, that money what you have lent, like your friend comes to you and say, "Yo, मेरे को 5,000 रुपए दे," तुम बोलेगा अच्छा कब तक देगा? 2 महीने तक दूंगा. So that 5,000 comes back to you. You are absolutely certain. So what is the Hindi word for fixed income? The Hindi word for fixed income is when you are absolutely certain. That means sunishchit aay. Sunishchit aay is the Hindi word for fixed income. Great. So on that note, signing off today. If you are really liking the video series that we are preparing, please like, comment and subscribe these videos. We will keep creating more videos and keep coming back to you. All the best and happy investing.